Hi, my name is George Pino. I'm the CEO of Commercial Brokers International. This quarter's outlook, I'd like to talk a little bit about the retail submarket, what we can expect with the bankruptcies, and what we're seeing with store closures, as well as the office market and, of course, multifamily. There's been a lot of talk lately of, actually some negative talk lately about the retail sector in commercial real estate, especially with the bankruptcies and store closures that we've been seeing primarily throughout the country itself. However, in the Los Angeles submarket, I still feel that it is still a pretty strong submarket, and if anything, I see it going into the second quarter really more of a stabilizing effect of what's happening. We're not going to see as much of a higher rental increases as we have in the last few years, and in fact, we'll probably see it stabilize and maybe come down a little bit. This is, of course, throughout the Los Angeles market itself. I see within the West Los Angeles market, it's still remaining pretty strong. You know, all the indicators are showing that it's a strong market. We have a 3.5% vacancy rate overall in West Los Angeles, from west of the 405 down to Marina del Rey, and 5.8% total availability. So what we're seeing in the retail sector for stores that are closing is landlords really focusing a little bit more on the experiential side of retail, going into whether it's gym use or restaurant use, things like that for the smaller spaces. For the larger spaces, we're actually seeing either them being broken up or being taken over with alternative type uses. So, you know, I think there's a lot of businesses out there that will adapt and will make the appropriate changes. If anything, in addition with the retail sector, what we're looking at, I'd probably look at the logistics side of things as well on the industrial side, where people try and compete against the Amazons of the world by having next day deliveries and 2-day deliveries. Federal Express actually just announced that they're going to start working with some smaller companies to do exactly that. And I think that's actually a pretty good upside market. So interest rates. There's been a lot of talk about this as well, and you know, as we saw and as expected, the Fed raised the base rate by about 25 basis points last quarter, and as we expect and continue to expect in the future, I expect that happening every quarter as well throughout the year. So what we're looking at is how is that going to actually affect the business. I think in the short term, not as much, but what we're going to start looking at is slowdown of the economy. You're going to see investors really start pulling back or looking for higher cap rates, which may affect pricing, especially in conjunction with rental rates flattening or coming down a little bit. So another sector of commercial real estate that's been getting a lot of attention has been the office market. And you know, overall what I'm seeing for especially for the second quarter of this year is the office market is going to remain fairly strong and stable. We've seen a flattening of the rates go from $4.64 on average for full service gross for all office types to $4.83 a square foot for Class A office space within that Westside submarket. That, of course, is again west of the 405 down from the 101 down to the Marina. So overall, we're seeing vacancy rates also remaining fairly stable, about a 9.4% overall. I don't anticipate that changing that much in the coming quarter at all, and you know, it still looks to be a fairly strong and good opportunity for investments. So one of the hottest markets of commercial real estate is the multifamily market. This has garnered a lot of attention as of late, with a lot of changes happening within the industry itself. What we have noticed, though, is that the construction starts are a little bit lower than from the year previous, with about 2,500 construction starts last year, and only about 1,650 or so this year. That doesn't include the 2,600 units that are roughly under construction right now, and that's just for the West Los Angeles submarket. You know, we're seeing a lot of construction activity within this market because rental rates are quite high, with you know, upwards of $5-6 a square foot on a gross basis for these newer multifamily properties. So a lot of talk in the last week or two has been the new law that Santa Monica just passed, which mirrors a little bit of what Los Angeles passed when it comes to the seismic retrofitting for soft stories. The Santa Monica law is actually a little bit more expansive than the Los Angeles law, including some of the steel frame buildings as well. And you know, looking at this and looking at what we've experienced in the Los Angeles submarket is that I don't necessarily see it as being a hindrance for some of the sellers, but I think it's going to be a little bit of motivation for some of the sellers to potentially get out of the multifamily or residential rental business within the Los Angeles or Santa Monica submarkets, mainly because of regulations that they have no control over and increasing their expenses without being allowed to pass them along to the tenants, which in turn, hurts their bottom line. So what we're seeing is a lot more interest from ownership, especially older owners that are looking to potentially sell the property, get out of the business, then transfer it into another asset class, which is less regulated and a little bit more, some may consider a little bit more safe as well. So overall, I'm still pretty bullish about the commercial real estate market for the next 3 months, at least for the second quarter, within the West Los Angeles market. I think that the changes that we're going to see are going to be relatively slow, even with rising interest rates. Overall, though, I think that investors really need to start looking and really vetting out their potential investments a little bit more so, and making sure that they're doing their due diligence and have the right people behind them to help them with that.